two allies, two thrones, one betrayal. On May 1st, 2026, the UAE did something it had never done in 55 years. It walked out. Not from a meeting, not from a deal. It walked out of OPEC. And when you understand why, you'll realize the Middle East will never be the same again. Let's go back. Way back. Because to understand what just happened, you need to understand what OPEC actually is. Not what they teach you in economics class, but what it really is. OPEC is not just an oil cartel. It has never been just an oil cartel. OPEC is a throne built from black gold, cemented by decades of backroom deals, political marriages, and strategic silence. And for over half a century, Saudi Arabia sat at the head of that throne, unchallenged, unapologetic, absolute. Every major decision that moved the global economy, every time you paid more for gas, every time an airline raised its ticket price, every time your heating bill spiked in winter, Saudi Arabia had its fingerprints on it. That is the level of power we're talking about. Not theory, not textbook economics, real power. The kind that reaches into your wallet from 10,000 miles away. And the UAE? The UAE sat right beside them, a loyal partner, a junior brother in the Gulf family. Abu Dhabi smiled at the meetings, signed the agreements, held the quotas, played the game. For 55 years, the UAE played the game. But here is what most people do not know. The UAE was never really playing the game. It was watching it, learning it, and slowly, quietly, building the capacity to blow it apart. Every year that passed, every barrel it was forced to leave in the ground, every compromise it made while others cheated, was just another year of preparation. Here is a number that will change how you see everything. 4.8 million barrels per day. That is how much oil the UAE was capable of producing before May 2026. 4.8 million barrels every single day. But do you know how much OPEC allowed it to produce? 3.2 million barrels. That is a gap of 1.6 million barrels every single day. Barrels the UAE had to keep buried, locked away, generating nothing, while its economy was being pressured by war, by disrupted shipping lanes, and by an Iran-controlled choke point strangling its exports through the Strait of Hormuz. Every single day, the UAE was forced to leave approximately $150 million worth of oil in the ground. Not because it could not produce it, not because the world did not need it, but because Saudi Arabia needed the price high to balance its own budget, and Saudi Arabia was in charge. Now here is where it gets deeply interesting. Because this tension had been building since at least 2021, when OPEC negotiations nearly collapsed entirely. Back in 2021, the UAE went to the table and made its case. We need a higher production baseline. Our capacity has grown. Our investment has grown. Our contribution to this organization has grown. We deserve a quota that reflects reality. Saudi Arabia and Russia, who, between them, essentially co-run OPEC, they stalled. They delayed. They offered a compromise. They raised the UAE baseline from 3.17 million barrels per day to 3.5 million. A crumb, a carefully calculated crumb designed to keep Abu Dhabi quiet without giving it real power. And for a few years, it worked. But you can only feed a man crumbs for so long before he stops coming to the table altogether. What makes the UAE's position uniquely threatening to Saudi Arabia is not just the size of its oil reserves. It is the money behind it. The UAE has some of the lowest fiscal break-even oil prices in the entire Gulf. The fiscal break-even is the magic number. The price per barrel a country needs to balance its national budget without running a deficit. For Saudi Arabia, that number sits above $80 a barrel. Some analysts put it closer to 90. For the UAE, it is dramatically lower, which means if the UAE floods the global market, drives prices down, and starts an all-out price war, Saudi Arabia bleeds. The UAE does not. That asymmetry is not a small detail. That is a weapon of economic warfare, and Abu Dhabi has been quietly sharpening it for years, smiling at the OPEC table while Riyadh set the rules. But the oil dispute is only part of the story. To truly understand the depth of this split, you have to understand that Saudi Arabia and the UAE have been quietly grinding against each other on almost every major geopolitical issue for the past 10 years. Let's start with Yemen. In 2015, both countries joined a military coalition to fight the Iran-backed Houthi rebels. They were supposed to be on the same side, and they were, until they were not. Because while Saudi Arabia wanted to restore the recognized Yemeni government in Sana'a, the UAE had a completely different objective. Abu Dhabi was backing Yemeni separatists in the south, fighters who wanted an independent southern state, not a united Yemen under Riyadh's preferred leadership structure. By late 2025, the cracks became craters. Saudi Arabia bombed what it described as a weapons shipment bound for UAE-backed separatists. The coalition that was supposed to project unified Gulf power had effectively collapsed from the inside. And that wound did not heal. It festered. Then came Sudan. As civil war tore that country apart, Saudi Arabia and the UAE again ended up backing opposing sides. Riyadh leaned toward the Sudanese army. Abu Dhabi had deep ties to the Rapid Support Forces, a powerful paramilitary group accused of carrying out devastating violence across the country. Two Gulf brothers, two different bets, and a country bleeding out. The pattern was impossible to ignore anymore. What looked like a united Gulf front to the outside world was anything but united at the strategic level. And then came the issue that made the divergence permanent and public: Israel. In 2020, the UAE signed the Abraham Accords and normalized diplomatic relations with Israel, becoming only the third Arab country in history to do so. It was a seismic, historic shift. It opened the door to defense cooperation, intelligence sharing, direct commercial flights, and deep economic partnerships with one of the most technologically advanced militaries on Earth. The UAE got access to Israeli cyber capabilities, advanced surveillance systems, and Iron Dome-class defense technology. Saudi Arabia watched, and Riyadh could not follow. The domestic politics, the weight of the religious establishment, the Palestinian question, the complicated position of being the guardian of Mecca and Medina, the stakes for Saudi Arabia normalizing with Israel were incomparably higher. The UAE moved ahead alone, faster, bolder, more independently than Riyadh had ever seen from any Gulf neighbor. Abu Dhabi was no longer asking for permission. Now overlay all of that onto the Iran war context. The United States and Israel launched military operations against Iran, and the Strait of Hormuz, the single most critical oil choke point on Earth, through which 1/5 of the world's oil and gas supplies normally flows, effectively closed. Iranian drones and missiles targeted Gulf infrastructure. Gulf oil exporters were suddenly struggling to move product through a contested, dangerous waterway. And here's where a secret decision made years ago in a quiet boardroom in Abu Dhabi becomes the most important infrastructure investment in the history of the modern Middle East. The Abu Dhabi crude oil pipeline, known by the acronym ADNO, runs from the interior oil fields of Abu Dhabi all the way to the Fujairah terminal, which sits on the Gulf of Oman, completely bypassing the Strait of Hormuz. It has a throughput capacity of 1.5 million barrels per day. This was not built by accident. This was not built as a precautionary measure taken lightly. This pipeline was constructed with the explicit strategic understanding that one day, whether through war, Iranian aggression, or deliberate geopolitical disruption, the Strait of Hormuz would close. And when it closed, the UAE intended to keep exporting oil while everyone else scrambled. Saudi Arabia has no comparable bypass infrastructure at this scale. That one decision, made quietly, funded enormously, executed over years, now represents perhaps the shrewdest single piece of energy infrastructure planning in the modern history of the Gulf. But here's what really breaks the story wide open. The timing of the UAE's OPEC exit was not random. It was not reactive. It was calculated to the week, possibly to the day. Think carefully about what was happening on April 28, 2026. The leaders of all 6 Gulf Cooperation Council nations were literally gathering in Saudi Arabia to discuss the regional crisis triggered by the Iran war. Saudi Arabia was the host. Saudi Arabia was trying to project unity. It was trying to show the world that the Gulf stood together. A solid bloc, a coherent alliance, a unified response to a shared threat. And at that exact moment, while the cameras were on Riyadh, while every global news anchor was watching the Gulf Summit, the UAE walked into that moment and detonated a diplomatic bomb. It announced it was leaving OPEC. Effective in 3 days, the message was not subtle, it was surgical. Abu Dhabi had chosen the most visible, most symbolic, most politically charged moment possible to declare its independence. And it did so without warning Riyadh. The UAE's energy minister, Suhail Mohammed Al-Mazrouei, was asked directly by journalists, "Did you consult Saudi Arabia before making this decision?" His answer was ice cold. The UAE did not raise the issue with any other country. Let that statement breathe for a moment. A founding OPEC member, a country that has shared the organizational stage with Saudi Arabia for over 5 decades, a country that has been called Riyadh's most trusted Gulf ally in virtually every Western intelligence briefing for 30 years, made the single most consequential energy policy decision of its generation without even picking up the phone to call Saudi Arabia. That is not a policy disagreement, that is a severance notice. Now let us talk about what this means for the global oil market with full precision. Before the UAE's exit, Saudi Arabia and the UAE together controlled the majority of the world's entire spare oil production capacity. More than 4 million barrels per day between them. Spare capacity is the single most powerful tool in an oil producer's arsenal. It is what allowed Saudi Arabia to stabilize markets after the invasion of Iraq in 2003. It is what allowed OPEC to absorb the COVID-era demand collapse and prevent a prolonged price spiral in either direction. Spare capacity is the invisible hand that moves oil prices even when it is never actually deployed. Because the mere existence of it signals to markets that extreme price swings can be corrected. And now that collective capacity, that market weapon, is split between two competing powers who are openly no longer aligned. Rystad Energy, one of the most respected independent energy research firms on Earth, said this plainly and without diplomatic cushioning. Losing a member with 4.8 million barrels per day of capacity and the ambition to reach 5 million takes a real tool out of OPEC's hands. And then came the line that should be engraved in every geopolitics textbook written from this point forward. Saudi Arabia is now left doing more of the heavy lifting on price stability, and the market loses one of the few shock absorbers it had left. Goldman Sachs moved instantly. They upgraded their oil price forecast for the final quarter of 2026. Brent crude to $90 a barrel, and West Texas Intermediate to 83. They cited lower Persian Gulf output, a slower than expected resumption of Gulf production, and what they called the unprecedented scale of the energy shock caused by the combined effect of the Iran war and the UAE's exit. The options market told an even starker story. Implied volatility on Brent crude options widened to levels not seen since the COVID demand collapse of 2020. Traders were essentially announcing, we have no reliable model for where this market goes. Nobody does. And when nobody knows, volatility becomes the new normal. Here is a number that puts OPEC's decline into brutal and almost poetic historical perspective. In the 1970s, OPEC controlled over 50% of global oil production. 50%. That was not just market dominance. That was the power to bring the entire industrialized Western economy to its knees, which they did. During the 1973 oil embargo, American gas lines stretched for miles. European governments turned off streetlights to save energy. Japan went into shock. That was raw, unmediated power over civilization itself. Today, without the UAE's barrels counted among its members, OPEC's global market share will fall below 30% for the first time in its entire history. Below 30%. In 50 years, the most powerful commodity cartel the world has ever assembled has lost nearly half its grip on global production. And the UAE's departure may be the event that makes this decline irreversible. Let us now talk about what the UAE actually does with its freedom, because the numbers here are extraordinary. The UAE has committed $145 billion in real 2026 terms to its domestic upstream oil sector over the next decade. Its stated production target is 5 million barrels per day by 2027. This is not an aspiration. This is a capitalized business plan executed by ADNO, one of the most sophisticated and aggressive national oil companies on Earth. ADNO has partnered with Western oil majors, Asian state buyers, and independent commodity traders to build what is essentially a fully vertically integrated global oil empire. It does not just produce oil, it refines it, it ships it, it trades it. And now, without OPEC's production ceiling, it will sell every barrel it can produce to every buyer on the planet. Once the Strait of Hormuz reopens, and it will reopen, whether through a negotiated ceasefire, a formal peace agreement, or sustained American naval pressure, the UAE is positioned to release approximately 1.6 million additional barrels per day onto the global market. 1.6 million barrels every single day. That is equivalent to roughly 1.5% of total global oil supply hitting markets at once from a single source. The price consequences of that volume will be felt in Houston, in Riyadh, in Moscow, in Beijing, and in every capital that depends on oil revenues to fund national budgets. And this is where Vision 2030 enters the story as a vulnerability. Saudi Arabia's entire national future, its political legitimacy, its social contract with its own citizens, its infrastructure transformation, its tourism projects, its technology ambitions, depends on oil revenues remaining high long enough to fund the transition away from oil. This is the defining paradox at the heart of Saudi Arabia's existence. Mohammed bin Salman has staked his entire legacy on transforming Saudi Arabia into a diversified modern economy. But he needs oil money to pay for the economy that is supposed to eventually replace oil money. Neom, the futuristic megacity being constructed in the northwestern desert at a projected cost of hundreds of billions of dollars, cannot survive a prolonged period of suppressed oil prices. Saudi Aramco, the state oil company that funds enormous portions of the Saudi government budget, requires prices above $80 a barrel to deliver its dividend obligations. If the UAE floods the market and prices compress significantly, Vision 2030 does not simply slow down, it structurally unravels. And if Vision 2030 unravels, the political legitimacy of the House of Saud enters territory that no one in Riyadh wants to contemplate. Meanwhile, what has the UAE been quietly building while all eyes were on Saudi Arabia? Look at the full picture. The UAE has deepened its military alliance with the United States more aggressively than any other Arab state in the past decade. It has integrated Israeli defense technology, advanced interception systems, cyber warfare capabilities, intelligence infrastructure through the Abraham Accords partnerships at a pace that has left even Washington analysts impressed. It is positioned Dubai as the undisputed financial capital of the new Middle East, processing capital flows that once moved through Beirut, rivaling Singapore and Hong Kong in transaction volume. And critically, it has signed long-term direct oil supply agreements with Asian megabuyers, China, India, Japan, South Korea, cutting out the OPEC pricing mechanism entirely and building bilateral energy relationships that bypass the cartel structure completely. Here is perhaps the most underreported and most significant angle of this entire story. The UAE's exit from OPEC is not primarily about today's oil market. It is a calculated bet on the future of energy itself. Kingsmill Bond, an energy strategist at think tank Ember Future, articulated it with precision that most analysts are still catching up to. The UAE has reached its conclusion about where global energy demand is heading. It knows that peak oil demand is either here or approaching. It knows that the energy transition, however slow and uneven, is real. And it has made a strategic decision that in a world where oil demand is eventually going to decline, the worst possible position to be in is an OPEC quota system that restricts your production while the window for selling oil at scale slowly closes. The UAE's calculation is brutal and rational at the same time. Sell everything you have as fast as you responsibly can before the world stops needing it. Volume over margin, speed over cooperation. Saudi Arabia's strategy is the mirror opposite. Restrict supply, keep prices high, maximize revenue per barrel. Use that revenue to fund diversification before it is too late. These two strategies are not just different, they are mathematically and structurally incompatible inside the same cartel framework. They were always going to collide. The question was never if, only when. And the answer turned out to be May 1st, 2026. Before we go further, there is one more layer of this story that almost nobody is talking about. And it involves the long game being played by ADNO, the Abu Dhabi National Oil Company, which is arguably one of the most underestimated state energy institutions on earth. While Saudi Aramco gets the headlines and the Wall Street coverage and the trillion-dollar valuation discussions, ADNO has been quietly executing one of the most aggressive upstream expansion strategies in the industry. It has brought in equity partners from ExxonMobil, Total Energies, BP, and INPEX. It has signed long-term supply agreements directly with Chinese state refiners, with Indian national oil companies, and with South Korean and Japanese buyers, building a customer base that is structurally independent of OPEC pricing mechanisms. It launched ADNO Gas as a publicly listed entity to attract global capital. It built out its trading arm to compete directly in commodity markets. And it did all of this while still technically being bound by OPEC quotas that prevented it from producing to its full capacity. Now those quotas are gone. ADNO is unleashed, and the company is going to move fast. The scale of what is about to happen in Abu Dhabi's upstream sector, the drilling programs, the capacity expansions, the new field developments that were paused pending the OPEC exit, represents one of the largest single-country supply expansions the oil market will have seen in years. That is the real market story, not the political drama, the barrels, the actual physical barrels that are now coming. Let us also confront the Russia dimension, because Russia's behavior inside OPEC Plus has been a source of deep and documented frustration for the UAE for years. After Russia joined the expanded OPEC Plus coalition, it and Saudi Arabia essentially co-managed the group's production decisions. And Russia, under crushing Western sanctions and desperately needing oil revenues to fund its military operations, repeatedly exceeded its production quotas, dumping discounted oil onto the same Asian markets the UAE was trying to build relationships in. Iraq did the same. The UAE watched other members cheat the system with impunity while it honored its own commitments with discipline. It watched Saudi Arabia look the other way at Russian quota violations because Riyadh needed Moscow as a partner in the production management architecture. For the UAE, OPEC Plus had become a system that protected Saudi and Russian interests at Abu Dhabi's direct expense. The exit from OPEC was not an impulsive reaction to a single grievance. It was the result of years of meticulous accounting, an internal ledger of every sacrifice made and every benefit denied. Saudi officials, according to regional sources, have privately referred to the UAE as a rebellious younger sibling. That phrase, when you think about it carefully, reveals everything about how this relationship actually worked for decades. Because that is genuinely how Riyadh saw Abu Dhabi. Smaller, younger, ultimately deferential, ultimately manageable. A partner to be managed, not a power to be respected as an equal. And for a long time, that framing was close enough to accurate that no one challenged it openly. But the UAE has been building toward this moment with extraordinary and deliberate patience. Its sovereign wealth fund, the Abu Dhabi Investment Authority, manages assets approaching $1 trillion. Its military has been combat tested in real theaters of war, trained by American and British special forces, and equipped with the most advanced systems its alliances could provide. Its economy is diversified in ways that Saudi Arabia's simply is not yet. The rebellious younger sibling did not just grow up. It quietly became more capable, more globally connected and more financially resilient than the elder brother who was too busy managing its own image to notice. What happens to OPEC from here? The honest answer is that without the UAE, one of the very few members with genuine spare capacity, financial sophistication, and long-term strategic credibility, OPEC becomes a club of mostly struggling producers, attempting to coordinate supply discipline that fewer and fewer members take seriously. Iraq chronically exceeds its quotas. Russia cheats when it needs to. Libya is perpetually unstable. Venezuela is rebuilding from the ruins of economic collapse. Nigeria faces persistent infrastructure degradation. Iran operates under sanctions that limit its market access. The members who actually want to enforce collective discipline are a shrinking minority, and the tools available to them grow weaker each year. Saudi Arabia still has its own massive spare capacity, and it can still threaten to flood the market to punish defectors. But the credibility of OPEC as a coherent institution has taken a structural blow from which full recovery seems unlikely. And this matters not just for energy investors or oil traders or Gulf finance ministers. It matters for every person watching this video from any country on earth. Because the price of oil does not stay in the Gulf. It travels. It travels directly into the price of every manufactured product shipped across an ocean. It travels into the cost of every flight you take, every delivery you receive, every kilowatt of electricity generated from natural gas. It travels into the inflation rates of developing economies that import oil and have no reserve buffer against price volatility. It travels into the foreign policy decisions of governments whose energy security depends on Gulf relationships that are now being renegotiated. Think about Pakistan, which imports almost all of its oil and has historically relied on concessionary Gulf pricing tied to Saudi goodwill. Think about Egypt, which has deep economic dependencies on Gulf investment and remittances. Think about every African economy whose IMF negotiations are shaped by commodity price movements that originate in decisions made in Abu Dhabi and Riyadh. Think about the geopolitical consequences in Asia, where China is the world's largest oil importer and is now watching with intense interest as its two most important Gulf suppliers begin openly competing for Chinese market share. Beijing does not need to do anything. It simply waits and lets the UAE and Saudi Arabia bid against each other for the privilege of supplying Chinese refineries with discounted crude. That is leverage China did not have to manufacture. The UAE-Saudi split handed it to Beijing for free. The UAE-Saudi split is not a story about two wealthy Gulf states disagreeing over production quotas. It is a story about the restructuring of the global energy order, and that restructuring will touch every economy, every government, and every household on this planet. We are watching, in real time, the unraveling of the most consequential energy alliance in the history of the modern world. We are watching the end of a 55-year institutional arrangement that helped set the price of almost everything that moved across the global economy. We are watching a smaller, younger, faster, and more strategically agile country tell the dominant regional power, we are done playing by your rules. We are done capping our production so that your budget balances. We are done sitting quietly at the table while Russia and Iraq take more than their share and you look the other way. We are going to produce every barrel we can produce. We are going to sell it to whoever will buy it on whatever terms we choose. We are going to build the most resilient, most diversified, most globally connected small state economy in the world. And we are going to do it with or without your blessing. And the world is watching. Every sovereign wealth fund manager in London, every energy minister in Beijing, every bond trader in New York, they are all recalculating who has leverage and who has lost it, recalculating which Gulf state is the future and which one is defending the past. The answers they reach will shape investment flows, diplomatic alliances, and military partnerships for the next generation. That is what happened on May 1st, 2026. That is what the headline reads when you remove the diplomatic language and look at what was actually communicated. The UAE did not leave OPEC because of a quota disagreement. It left because it had outgrown the arrangement entirely, and because it finally had the infrastructure, the alliances, the fiscal resilience, and the strategic clarity to walk away without looking back. The world's most important oil relationship just ended. Not with a war, not with sanctions, not with a dramatic summit collapse. With one sentence delivered to the press. And the reverberations of that sentence will ripple through energy markets, through Gulf politics, through Asian supply chains, through African development models, and through the balance sheets of every oil-dependent government on Earth. The consequences are not coming. They are already here. They are already being priced. They are already reshaping the conversations happening in every Ministry of Energy and every Foreign Affairs office on the planet. And they are only just beginning. The Middle East will never look the same. The oil market will never function the same. The power dynamics of the Gulf will never be the same. And the world, ready or not, is about to live inside every consequence of a rivalry that has finally, after 55 years, come fully and irreversibly into the open. 2 allies, 2 thrones, 1 war. It has already started. You just watched it begin. Now you know what almost everyone else completely missed.